Recent risk upgrades to emerging markets by major institutions are technically correct but strategically misleading. They're hiding a massive accumulation of credit damage. Top-level index gains are actively masking a fractured fiscal plumbing system underneath. The damage is concentrated in a specific universe: energy importing frontier sovereign credit. Following the consensus index right now means blindly buying into a dangerous composition error. This chart breaks down the MSCI emerging markets 10.7, overwhelmingly driven by AI hardware and Latin American energy exporters. Underneath, the Iran ceasefire breakdown triggered an oil shock, violating the IMF's baseline commodity assumptions for the remaining index. The index illusion relies on the massive earnings upgrades flowing into Taiwanese and Korean semiconductor producers, but sovereign credit investors do not hold tech exposure. We hold the balance sheets of nations, absorbing this energy choke point as a severe balance of payments hit. We are tracking immediate sovereign stress. Turkey burned $20 billion in a single month of sterilization interventions, and Pakistan's $3.5 billion bilateral creditor architecture is actively cracking. This localized balance of payments crisis is compounding quietly in sovereign budget lines, completely invisible in the aggregate index returns. There is a secondary systemic vulnerability developing completely outside mainstream models: redemption pressures building inside business development corporations. This data gauge tracks Bank of America's analysis on private credit outflows. It indicates 10 to 20% of AUM are facing withdrawal requests. The clock started during 2023. 5 quarters of sustained maximum redemptions triggers forced portfolio liquidation. When private credit managers are forced to liquidate, they sell their most liquid assets first. That selling pressure will target emerging market high yield. This private credit stress event will cascade directly into our sovereign asset class before mainstream market commentary registers the flow. Here is how we position. We maintain an overweight strategy in Korean and Taiwanese technology-adjacent sovereign credit, strictly targeting instruments with direct fiscal links to the AI hardware export cycle. Conversely, we currently hold asymmetric short-duration positions across these highly vulnerable energy-importing frontiers. Tracking the broad EM index right now introduces massive basis risk. Overweighting the index guarantees you are simultaneously underweighting the specific credit deterioration we need to avoid. The aggregate is the wrong unit of analysis. The composite index's outperformance is acting as an alibi for massive underlying sovereign risk. Front-run the liquidity cascade. Access the full briefing document for exact portfolio positioning at emergingmarketasymmetry.com.